The S&P 500 is widely considered the ultimate financial safe haven. It takes the absolute chaos of the stock market and filters it into a reliable wealth engine, historically delivering average returns over 10% a year. You buy a small piece of the 500 top American companies, set it and forget it. But the mechanics of this index have a catch. It relies on something called market cap weighting, which simply means the more valuable a company becomes, the bigger slice of the fund it takes up. You aren't buying equal pieces of 500 companies. As the winners grow, your diversification mathematically shrinks. Looking at this chart of the 500 companies, you can see the reality of that math today. For every single dollar you invest into the index right now, 40 cents goes straight into just 10 companies. Those top 10 blocks are swelling, crushing the other 490 companies into an afterthought. Zooming in on that concentration, one single block, NVIDIA, is eating up between 7 and 8 cents of every dollar you invest. By sticking with the default safe index, you are effectively placing a concentrated, leveraged bet on the future of the AI tech sector. These top tech companies are financing their AI ambitions by taking on staggering amounts of debt. OpenAI's Sam Altman is willing to commit $1.4 trillion to AI infrastructure, while his company makes between $13 and $20 billion in yearly revenue. The math gets very tight when you look across the sector. For all of these AI companies to justify their current stock prices, they would need to generate roughly $2 trillion in future revenue. That is more than NVIDIA, Microsoft, Apple, Alphabet, Amazon, and Meta combined made in 2024. They are supporting these valuations through a complicated feedback loop. These tech giants are essentially passing investment money around to each other, artificially bumping up their own valuations on paper. Passive index investors are the fuel keeping this engine running. Because the fund is market cap weighted, every automated biweekly deposit from millions of retirement accounts blindly pushes those tech prices higher. This gives them even more money to grow, regardless of what they actually earn. This self-reinforcing cycle is inherently fragile. If AI development stalls or profits fail to materialize, the resulting shock could collapse the entire S&P 500. One obvious fix is to force the index to behave. You can move your capital to an equal-weighted S&P 500 fund. Instead of letting the biggest companies dominate, every single company is capped at a strict 0.2% of the portfolio. The immediate benefit is clear. Your exposure to a potential AI tech crash drops from 40% down to 2%. You get the broad U.S. market without the heavy concentration risk. But maintaining that perfect balance requires a complex mechanical trade-off called negative momentum. As you see in this diagram, whenever a company starts to grow in value, the fund automatically sells off shares to keep it pinned at that 0.2. This automatically spreads your capital across thousands of companies in over 45 developed and emerging countries. It is very easy to assume the American markets will dominate forever, because they have for the last 14 years. But the historical data shows global economic leadership constantly shifts. In the year 1900, the United Kingdom held a massive 24% share of the global stock market. British companies controlled global trade, and London was the undisputed financial capital of the world. Betting against them would have seemed ridiculous. Decades later, a similar pattern emerged in Japan. By the late 1980s, Japanese tech and automotive companies were booming, while the U.S. economy struggled with high inflation. Many investors were absolutely convinced Japan was the permanent future. A global fund acts as geopolitical insurance. If a new country takes the lead, the fund automatically adjusts to capture that growth. But there is a clear trade-off. If the U.S. tech monopoly continues its historic run, a globally diversified fund will mathematically underperform a pure S&P 500 index. You are choosing to sacrifice the potential for absolute peak tech returns in exchange for the certainty of a global economic safety net. If you still want to capture the upside of artificial intelligence, you can bypass the $2 trillion infrastructure giants entirely and hunt for smaller, specific applications. Right now, companies like NVIDIA and Meta sit in the crowded zone. They have massive market caps, highly expensive valuations, and they are fighting a debt-fueled arms race to build the biggest AI models. Everyone is already invested here. As this chart illustrates, the real opportunity sits in the bottom left, the overlooked zone. These are mid-cap software companies. They aren't spending billions to build foundational models. They are simply integrating existing AI into their products to solve real problems. An AI price war is already brewing. As all the major AI models get closer in ability, they become interchangeable. When that happens, the value won't stay with the massive companies carrying billions in debt. It will flow down to the lean, mid-cap integrators who use that technology in the smartest, most cost-effective way. Targeting this overlooked zone allows you to profit from the AI revolution without holding the bag on massive infrastructure debt. The catch is that it requires the higher effort and inherent risk of active stock picking. Finally, you can build an absolute floor beneath your portfolio by elevating your cash reserves and allocating a strategic percentage to physical gold. There is a massive systemic shift happening right now. Gold has officially been reclassified as a Basel III Tier 1 asset. This means central banks can now legally treat their gold reserves exactly the same as cash on their balance sheets. Because of this rule change, central banks worldwide are aggressively hoarding physical gold. China, in particular, is buying up more gold than ever to build trust in international trade outside the US dollar. All of this institutional buying is driving up baseline demand. Alongside gold, cash gives you strict strategic value. The most successful value investor in history, Warren Buffett, has aggressively increased his cash pile to over $340 billion. He holds cash so that when a market bubble eventually pops, he has the liquidity to buy deeply discounted assets. Cash will slowly lose value to inflation, and gold doesn't pay a quarterly dividend, but they are not designed to grow your wealth. They are strict insurance policies, engineered to give you absolute liquidity and purchasing power during a catastrophic market crash. Looking at this portfolio map, the strategy becomes clear. You shouldn't abandon the S&P 500 entirely. Instead, you need to hold that core position and structurally adjust the rest of your portfolio based on your specific risk profile. If you are a set-and-forget beginner, your path is straightforward. Maintain your core S&P position, but direct your new automated contributions into a global index. This neutralizes your exposure to localized US tech risk without requiring you to actively manage your trades. If you are an active optimizer, you hold that S&P baseline, but actively deploy your new capital into the mid-cap overlooked zone. You do the research to find the smaller companies applying AI to real problems, hunting for safe upside away from the mega-cap giants. And if you are a capital preserver, your priority is building a 10 to 20% buffer in cash and gold. This guarantees your liquidity and ensures your lifestyle survives a heavy market correction. You cannot predict the exact top of the market or the moment a bubble pops. Survival depends on engineering your portfolio mechanics so your wealth remains intact, no matter which way the market breaks.